$3,230. That is what 1 ounce of gold costs today, and Wall Street analysts are calling anyone who buys it right now reckless, delusional, and late. They are calling it the most hated trade in gold. And I'm going to show you exactly why the people doing the hating are the same people who are quietly loading their vaults at every single dip. You are watching this because the mainstream won't show you what is actually happening in the gold market right now. They will show you the price. They will not show you the flow. They will show you the headline. They will not show you the filing. And they will absolutely not show you what is being moved out of London, out of New York, and into the hands of sovereign buyers who are not selling, not at $3,000, not at $3,200, and not at whatever number flashes on your screen next week. So let's start with the number that should have made every financial headline this morning and didn't. In the first quarter of 2025 alone, central banks globally added 244 tons of gold to their reserves. That is not a misprint. 243 tonnes in a single quarter. Now, I need you to understand what that number means in real terms. 1 ton of gold is approximately 32,150 troy ounces. Multiply that by 244. You are looking at roughly 8 million ounces of physical gold removed from the open market, bought, vaulted, and not available for sale in 90 days. Paper says gold is overpriced. The vault says something different. And here's what they are not telling you. Those purchases were largely made at prices between $2,600 and $3,000 per ounce. These are not retail investors panic buying. These are the finance ministries of Poland, China, India, Turkey, and the Czech Republic making coordinated, strategic, multi-billion-dollar decisions. These are not people who are wrong very often. But that is not the part that should concern you. The part that should concern you is what is happening at the same time on the other side of the trade. Because while sovereign buyers are pulling physical ounces out of the market at a rate we have not seen since 1967, the year before the London gold pool collapsed, institutional desks on Wall Street are still positioning short. Still, today, let me give you the specific number. As of the most recent Commitment of Traders report, the managed money category, that is hedge funds and institutional speculators, held 108,000 short contracts on COMEX gold futures. One COMEX gold contract covers 100 troy ounces. Do the math. That is 8 million ounces of paper short exposure sitting in a market where physical supply is being vacuumed up by sovereign actors at a record pace. 8 million ounces of shorts. 8 million ounces of sovereign buying in 1 quarter. Once you understand the ratio, the price action makes sense. This is not a market where gold is overpriced. This is a market where 2 completely different games are being played on the same board. And the question is not whether gold goes higher. The question is what happens to those 108,000 short contracts when the physical supply finally disconnects from the paper price entirely. And before we get into that, if you are not subscribed to this channel, fix that right now. I cover the data that institutional traders read, but don't want you to understand. Hit subscribe and turn on the notification bell, because what we're going to cover in the next 14 minutes is the kind of analysis that rewrites how you see every gold price move for the rest of your life. Now, let's talk about the anomaly hiding in plain sight. The LBMA, the London Bullion Market Association, is where the majority of physical gold changes hands globally. It is a wholesale market. Professional buyers, multi-ton transactions, and in March of 2025, the LBMA reported that gold lease rates, the cost to borrow physical gold from a vault, spiked to levels not seen since 2008. Let me explain what that means, because this is critical. When lease rates spike, it means the people who own physical gold are not willing to lend it. They are holding it tight, which means the people who need physical gold to settle contracts, paper contracts, derivative contracts, futures contracts, are running out of easy supply to borrow. The spread between the LBMA spot price and the COMEX futures price, what traders call the EFP, exchange for physical, blew out to over $60 per ounce in February. $60 per ounce. That is not a rounding error. That is not normal backwardation. That is a structural dislocation. Paper says one price. Physical says 60 more. And the gap didn't close. It widened. Now here is where this gets interesting. Because if this were a one-time anomaly, a blip, a settlement quirk, a temporary logistical hiccup, we would expect it to resolve itself within days. Arbitrageurs would move gold from London to New York. The spread would compress. The market would self-correct. That is not what happened. The EFP spread stayed elevated for 6 consecutive weeks. 6 weeks. And during that same 6-week period, COMEX reported that registered gold inventories, that is the gold that is actually available to deliver against open futures contracts, fell by 4 million ounces, from 9 million ounces in January down to 5 million ounces by late February. Think about what that means alongside the short position data I just gave you. You have 8 million ounces of short exposure. You have 5 million ounces of registered deliverable gold. That is a coverage ratio of 88 cents of physical gold for every dollar of paper gold short. In theory, in a perfectly liquid market, this is manageable. In practice, in a market where sovereign buyers are removing 7. 8 million ounces a quarter from available supply. This number doesn't exist in a fair market. And then something strange happened to the vault numbers. In January 2025, JPMorgan filed amendments to their COMEX warehouse reports showing a reclassification of approximately 3 million ounces from eligible to registered gold. Eligible means it's in the vault, but not available for delivery. Registered means it is cleared and available. On the surface, that sounds like good news. More gold available to deliver. But here's what they filed at 3 a.m. that nobody is talking about. Those same amendments were followed within 30 days by a series of customer withdrawal notices totaling 9 million ounces from the same warehouse facility. So JPMorgan reclassified 3 million ounces is available, and then 9 million ounces walked out the door within the same month. Why reclassify it if you're just going to let it leave? Wall Street is not confused. They know exactly what this means. Let me show you the pattern now, because this is not the first time we have seen this playbook. Go back to April 2011. Gold is trading at $1,500 an ounce and climbing. The COT data at the time shows managed money short positions building while physical premiums in Asia, specifically the Shanghai Gold Exchange, are trading at a $15 to $25 premium over LBMA spot. Sound familiar? That premium held through the entire dump, even even as Western paper markets drove gold down to $1,320 by May, the Shanghai premium stayed elevated. Physical buyers in the East were not selling. They were buying the dip that the West was engineering. Same playbook, different decade, and then go back further. September 1979. Gold is at $400 and the mainstream financial press is calling it a bubble. Lease rates are spiking on the LBMA. Sovereign buying from the Middle East and Asia is quietly accelerating. And a small group of institutional insiders is building massive short positions in COMEX paper gold, betting that the price cannot sustain itself. We know how that ended. Gold hit $850 an ounce by January 1980. That is a 112% move in 4 months. Once is accident, twice is coincidence, 3 times is policy. Now let me connect the third data point, because this is where the pattern becomes undeniable. The Shanghai Gold Exchange. Right now today, the SGE is trading gold at a premium of between $18 and $32 per ounce over LBMA spot price. $18 to $32 for the same metal, for the same ounce. Just in a different city, in a market that Chinese regulators allow to function closer to actual supply and demand fundamentals. The West is still pricing this like 2019. The premium held through the entire dump in late February when COMEX gold futures sold off $80 in a single session. The premium held. In fact, on the day of the biggest single session paper sell-off, the SGE premium actually widened from $22 to $29. That means Eastern physical buyers looked at the Western paper sell-off and said, give me more at that price. Now I want you to stack these data points and really let this land. Data point 1, COMEX registered gold inventories are down 4 million ounces since January. Data point 2, LBMA lease rates are at their highest since the 2008 financial crisis. Data point 3, JPMorgan reclassified and then saw 9 million ounces exit their warehouse within 30 days. Data point 4, Shanghai Gold Exchange premium is at $18 to $32 and widened during the paper sell-off instead of compressing. Data point 5, central banks bought 244 tons of physical gold in Q1 2025 alone. 5 independent data points, 5 different sources, 5 different markets, and they are all saying the same thing. Physical gold is being pulled from Western vaults faster than it can be replaced, and the paper price has not caught up yet. Here's what should really disturb you. If you look at the CME Group's open interest in gold futures right now, the total number of outstanding contracts, you get 533,000 contracts. Each contract is 100 ounces. That is 3 million ounces of paper gold exposure. COMEX registered deliverable gold, the gold that could actually be called upon to settle those contracts, stands at 5 million ounces. That means there are 6 paper claims for every single real ounce that can be delivered. 6 to 1. In gold's case, not silver's traditional 80 to 1 ratio that we talk about on this channel, but gold's ratio has now blown out to 6 to 1 and climbing. The last time this ratio was this elevated in gold specifically was Q4 of 2022, right before gold ran from $1,620 to $2,050 in under 6 months. Why did JPMorgan reclassify 3 million ounces and then watch 9 million walkout? How can 6 paper claims exist for every real deliverable ounce? And here's the one they really don't want you asking. Who are the counterparties on the other side of those 108,000 short contracts? And what happens when they get a delivery notice? If you want to keep following this story as it unfolds, subscribe right now. We are going to be tracking every COMEX warehouse filing, every SGE premium data point, and every COT report as this unfolds. Subscribe to The Hidden Economy. This is the analysis the mainstream doesn't run. So who gets hurt? Let's talk about that plainly. Because this is the part the financial entertainment industry will not cover for you. Because the people who would get hurt are also the people who buy the advertising. The entities most exposed to a violent short squeeze in gold right now are the institutions carrying those 108,000 short contracts on COMEX, the managed money category, hedge funds, algorithmic traders. Some of the biggest names in macro finance who built models that say gold corrects when the dollar strengthens or when real rates rise. Those models have not been updated for a world in which central banks are no longer playing by the same rules, where countries like China, Russia, India, and Poland have made an explicit sovereign decision to reduce dollar-denominated reserve assets and replace them with physical gold that no one can sanction, freeze, or devalue with a printer. The models are wrong, the gold is gone, and the shorts are still on. When a short squeeze happens in a commodity market, and this is important, it does not happen gradually. It does not politely give you time to exit. It happens when a delivery notice lands, when someone on the long side of a futures contract says, I do not want cash settlement, I want the metal, and suddenly the short seller has to go find 100 ounces of registered deliverable COMEX gold in a market where the ratio is already 5, 6 to 1, and deliver it within the settlement window. If they cannot find it, they buy it at whatever price it takes. That is how you get 200-a-day moves in gold, not from retail investors, not from YouTube channels, from panicked institutional shorts scrambling to cover positions that should have been unwound 6 months ago. And here's what they will tell you when it happens. They will say it was geopolitical risk. They will say it was a surprise Fed pivot. They will say inflation came back hotter than expected. They will give you a clean, tidy narrative for a $300 move that they did not predict and cannot explain with their models. Paper says it was unexpected. The vault said it was coming for months. Now let me show you the 3 types of people watching this video right now, because your response to this information is going to determine where you end up when this move happens. Type 1 is panicking. Type 1 has been watching gold run from $1,800 to $3,200 and is convinced they missed it. Type 1 is saying, I'll wait for the pullback, and has been saying that for 2 years. Type 1 is not thinking about the data. Type 1 is managing fear, not a portfolio. Type 2 is confused. Type 2 sees the data, but doesn't know what to do with it. Type 2 owns some gold, maybe an ETF, maybe a few coins, but hasn't thought about what delivery mechanics mean or why the difference between a gold ETF and a gold coin matters in a short squeeze. Type 2 is frozen. Not wrong, but not positioned to benefit either. Type 3, and I suspect this is you because you are still here 14 minutes into a video about vault inventory data and lease rates. Type 3 understands that the price you see on the screen is a paper price generated by a paper market that is increasingly disconnected from the physical reality of where actual ounces are sitting and who actually owns them. Type 3 is not buying gold because they think it goes up on a chart. Type 3 is holding gold because they understand that when 6 paper claims exist for every real ounce, something eventually has to give, and it will not be the gold. So what does Type 3 actually do with this information? This is not financial advice. Your money, your decisions, but let me tell you what the data is telling anyone who is paying attention. If you already hold physical gold allocated in your possession or in a segregated vault where you are the named owner of specific bars, you are in the strongest position you can be in. The data says physical premiums are rising. The data says lease rates are spiking. The data says sovereign buyers are not selling at these prices. You do not need to do anything except understand why you own what you own. Patience is the position. If you hold a gold ETF, specifically a paper-backed ETF that does not guarantee physical delivery, you need to understand what you actually own. Most ETFs hold gold through a custodian structure with sub-custody arrangements. In a genuine delivery crunch, your ETF's ability to deliver physical gold to you is dependent on those custodial chains functioning perfectly. Look at your ETF's prospectus. Look at how they handle redemptions in excess of $50 million. You may find language that surprises you. If you are a leveraged trader, futures, options, spread trades, the data I have presented today should give you serious pause about holding naked short positions in gold through May and June. The COMEX June contract open interest is elevated. Delivery windows begin sooner than most retail traders track. And if you are sitting on the sideline waiting for gold to come back to fair value, I need you to ask yourself, fair value according to what? According to a model that assumes LBMA lease rates are normal? According to a framework that doesn't account for 244 tons of sovereign buying per quarter? The West is still pricing this like 2019. If the physical market has moved, and the data shows it has, then waiting for a paper price to confirm what the physical market already knows may mean waiting until the move is over. Wall Street is not confused. They know exactly what this means. The most hated trade in gold is hated for a specific reason. It is hated by the people who are short. It is hated by the commentators whose models don't explain it. It is hated by the newsletter writers who called $2,500 a top and have been revising their targets upward in silence ever since. The hatred is not analysis. The hatred is a position. And positions get covered. Once you understand the ratio, the price action makes sense. Let me close with the historical anchor, because this matters. In 1979, the conventional wisdom on Wall Street was that gold at $400 was a bubble fueled by inflation panic and Middle Eastern petrodollar recycling. Sober, serious analysts wrote serious, sober pieces in the Wall Street Journal about why gold would return to $250. They had models, they had data, they had credentials. Gold went to $850 in 4 months. In 2010, the conventional wisdom was that gold at $200 was a crisis trade that would unwind as the global economy recovered from 2008. The Fed was going to normalize, inflation was contained, gold would fall back to $800. Gold went to $199.20 in 14 months. Now in 2025, the conventional wisdom is that gold at $3,200 is a geopolitical premium that will fade when the political situation stabilizes. Central bank buying will slow, real rates will rise, gold will correct to $2,400. Same playbook, different decade. And I am going to tell you what I think is actually different this time. Not in the way people usually say this time is different to rationalize a bad trade. Different in a structural, measurable, data-confirmed way. The difference is de-dollarization. In 1980 and in 2011, every country that was selling gold and buying dollars was doing so inside a system they trusted. The dollar was the reserve currency. SWIFT was the rails. US Treasuries were the safe haven. That system is not collapsing, but it is fracturing, quietly, methodically, at the sovereign level. When Poland adds 130 tons of gold to its reserves in a single year, they are not doing it because they think gold goes up on a chart. They are doing it because they want reserves that exist outside the reach of any single nation's foreign policy. That is a structural bid. That is not a trade. That does not show up in COT data because it is not happening through COMEX. It shows up in LBMA withdrawal statistics and in SGE import data and in central bank reporting that gets filed quarterly and reported on page 17 of a PDF that nobody reads, except we do. If you made it this far, I want to ask you one thing before we close. Not a rhetorical question, a real one. Drop your gold price target for the end of 2025 in the comments right now, not the mainstream target. Your target based on everything you just heard. I read every single comment and I want to see what this audience actually thinks when they have the real data in front of them, and share this video with one person who is sitting on cash right now waiting for certainty. There is no certainty in markets. There is data, and the data is speaking very clearly if you know how to listen to it. Subscribe to The Hidden Economy. I'm going to keep tracking these vault numbers, these lease rates, and these sovereign purchase disclosures so that you are never caught off guard by a move that the data was telegraphing for months. Hit the notification bell, because the next video we are publishing is going to cover something that almost nobody in the gold community is talking about yet. The May COMEX delivery window, which opens in less than 3 weeks, and the open interest numbers that are sitting around it right now that make February's EFP blowout look like a warm-up. 3 weeks. Here's the unresolved question I am going to leave you with, and it is not a small one. If sovereign buyers are removing physical gold from Western vaults at 8 million ounces per quarter, and COMEX registered inventory is already at 9, 5 million ounces against 53. 3 million ounces of paper exposure, and the May delivery window opens with open interest that has not meaningfully declined. Who delivers? Watch what happens in May. I will be here.